Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
Hi, welcome to this podcast initiative of SBI Mutual Fund, where people from our fund house speak about how they work, their investment philosophies, and what they are doing on the fund strategies they manage. I'm Rohit Shimpi from the investments team. I've been with the fund house for over 10 years. Apart from investing, I also enjoy music, books, and cars, but this is a show about investing. So let's begin. Coming back to the topic of our conversation today, I have with me my colleague and dearest friend Srinivasan. Actually, we and everyone else we know calls him Vasan, to talk about his fund, the SBI Emerging Businesses Fund. Welcome to the show, Vasan. It's wonderful to have you here.
Thanks, Shim. Pleasure.
Okay, so the objective of this conversation is to learn from you what the fund is about and how you go about managing it.
Sure.
And for those of you listening, this is a strong disclaimer. This is not a sales pitch or a prompt to entice you to buy the product. This is just about familiarizing you with the fund, the managers, and more importantly, the investment process behind it. Mutual fund investments are subject to market risks. Past performance is no indication of future performance. And please read our offer documents carefully before investing. Now, Vasan, let's get back to the SBI Emerging Businesses Fund. Can you start by telling us what this fund is all about?
Yeah. So let me call the fund EBF. It's easier. EBF is essentially a bottom-up, concentrated conviction philosophy that focuses on generating absolute returns reasonably above cost of capital in the long-only context. It's inherently high risk given that we are benchmark, sector, and market cap agnostic.
Whoa, that was a lot to take in. Can we go about it again, but slowly, please?
Yeah. So this is a fairly concentrated portfolio of about 20-25 stocks. Right now we have 21. And it's focused on generating a return of, say, reasonably above cost of capital. The long only context means we don't really try timing the market by taking any cash call. We're essentially trying to build a portfolio of stocks that will give you these returns based on their earnings characteristics or valuation re-ratings. Why is this fund risky? A lot of people think because it's concentrated. I don't. But it's risky because it's not built to be consistent against a benchmark or say a typical market or a Nifty or a Sensex. We are also not really bothered about controlling risk in terms of conscious sector diversification or some kind of a size bias. What's risk for us in the context of this fund? It's just the risk of going wrong in our stock calls.
You spoke about concentration. Clearly, it's a conscious philosophy here. So you think portfolio returns have a lot more to do with portfolio sizing rather than just stock selection?
Absolutely. Also, if you Google portfolio diversification, there does seem to be more than enough evidence that diversification kinds of peters out after I think 15 stocks, maybe 20. But on second thoughts, if people think that these many or rather these few are risky beyond a point, I'll go with that. For the last 7 years, we've always started with saying that there is a strategy with the highest risk technically in our product portfolio.
But do you really believe that?
You're trying to corner me, aren't you? Well, no, I'm personally comfortable owning even 7 stocks in a portfolio, assuming I know enough about these companies. But somewhere I guess there is a personal aspect to it, and beyond the Google stuff, I don't consider myself an expert on the portfolio diversification topic.
Yeah, point taken, Vasan. Let's move on. You talk about absolute return. Can you elaborate, please?
Sure. So we are targeting, say, 5 to 7% above cost of capital. That's what we are trying to achieve, rather. And it started off with a much higher number, honestly. There is clearly this implicit assumption that if we do achieve what we're targeting, we'll end up doing a wonderful job, even in terms of beating the market and our PSA. I guess somewhere this is inspired by the fact that the Sensex has delivered a CAGR of 15 to 16% over the last 25 years or so, even more.
Well, I'm happy to put my money in for that kind of return. But you talked about this being risky. I presume that means volatility against the benchmark?
Yes, but hold that thought. Let me go back a bit and try to articulate risks that are inherent in such a strategy. Technically speaking, there are 3 types of risks aside from the concentration stuff we already talked about. First is the benchmark risk. This fund is pure bottom up and benchmark agnostic. Now that leads to a pretty high tracking error against our benchmark, which is BSE 500. The second risk comes from the fund being sector agnostic. We don't have active sector limits for this fund like we do for the others. Sector weights are simply a derivative of the stocks we've picked. There is no a priori bias. Though I should add, we do like certain themes. The third risk, and I love this rule of three, comes from the fund being market cap agnostic. While liquidity is definitely controlled from an overall portfolio perspective, we do not have any particular bias to size.
So let me stop you for a moment there. Haven't you always been biased towards mid caps?
Yes, we've definitely had a higher proportion of mid and small caps as long as I've known. But that's been more automatic rather than a conscious preference. Look at it this way. We define large caps as the top 100 and everything else is mid and small. So the probability that your best 20-25 stocks is mid cap is but naturally higher, isn't it? Right now, close to 45% of the portfolio is large cap, which is partly due to the fact that those stocks are also what we like and because of liquidity.
Oh yeah, sorry. So you were talking about those three risks.
Yeah, benchmark risks, sector risks and market cap risks. But you know the funny part, what the funny part is, I personally don't see them as real risks because we're not really trying to mitigate them. The biggest risk in my view is that we end up picking the wrong business and more importantly, we don't realize that early enough. Like Warren Buffett famously said, risk comes from not knowing what you're doing. Now that's a work in process.
Yeah, that was very nicely articulated. But coming to my next but very basic question, how do you go about the stock selection process?
That is simpler. We look to buy a good business run by excellent people at an attractive price.
That's it.
Yeah, that's it.
That's the most cliched statement I've heard.
Isn't it? But cliched is good because it's simple and simple works. So let me try and explain.
Please.
Like I said, we're looking for three characteristics: a great business, a great management, and a great price, which is what everyone does, right? Maybe or maybe not. Let us imagine the different types of philosophy that investment managers run. You have growth, value, momentum, top down, bottom up, contrarian, quant, arbitrage, activist, market timing, special situations, large cap, mid cap, whatnot. By staying focused on just these three characteristics, I'm automatically choosing not to do a number of the above. If parts of them go into me finding a good business, a good management and a fair valuation, so be it. So what defines a great business? For one, it needs to have some kind of a competitive advantage, Google economic moat. Two, it needs to be able to generate a reasonably high return on capital. Three, it has to be scalable. To be able to generate high returns on capital and at the same time grow at a fast clip is like the best of both worlds, like having the cake and eating it too. 4, low capital intensity. 5, high cash generation. 6, pricing power. 7, longevity. I can go on. That's about the business. Managements can be cross-referenced for integrity, capability and vision through their track record. Look for transparency, accountability and clarity of thought when you talk to them. Coming to the third part, the good price is something that essentially gives you a margin of safety. It's not only in terms of PE ratios and price to books, but also in terms of the stability of the business model and the earlier factors that you put together that give you the margin of safety. And you need to think of all these not in black and white, but in different shades of gray. You'll never get the ideal condition. It's about weighing the different variables for their intensity or closeness to where you want them to be and choosing the best combination. That's where the art part comes in, I suppose. Remember what Poe's dad told him, there is no secret recipe.
Oh, from Kung Fu Panda.
Yeah.
I love that movie. And that didn't sound all that cliched actually. It did when you started, but not later on.
Thanks.
So basically you think it's about starting with a simple enough philosophy and then drilling much deeper.
Right.
So I'm wondering, after listening to you, does this not bias your portfolio heavily towards quality?
Yeah, that's a good question. And I've often wondered about it. While not consciously intending it, I have to admit a lot of these factors we think in terms of lend a quality bias to the portfolio. Now there's nothing wrong with it per se. It's only bad if we ignore the price or valuations. While you want to buy a great business with great people running it at a price that more than factors, it kind of offsets the whole effort. The way to avoid this is to keep thinking about valuations all the time and ask yourself if the various assumptions you are making about the business, whether it's growth, return on capital or the length of the honeymoon period, all these with respect to valuations, whether they are in a zone that you're comfortable with.
Great. At this point, let me sum up what we've discussed so far. We started off with your investment philosophy for this fund. We spoke about concentration and portfolio diversification. You articulated the risks inherent to this kind of a portfolio. We also talked about how you go about selecting stocks and how you think about expected returns. At this point, let me move to ask you some more specific questions to what I've noticed about looking at the last few years' data on the fund. I know you said you're sector agnostic, but you really seem to have had a preference towards consumer discretionary and industrials. Do you think it's a subconscious or a familiar zone that you like to play in? Is it like a comfort spot? Also, consumer discretionary doesn't seem to be a favorite anymore.
No, there is really no bias, but there are certain themes that we've liked as a fund house, such as the aspirational consumption theme, manufactured exports, or an existing large market opportunity, rather size, having the potential to move from the unorganized to the organized sector. These are not conscious biases, but more like thematics that fit the earnings compounding angle that we're looking for. If I'm in a stock which is best in class in an industry which is multiple times the company's size, with a potential to move from unorganized to organized, this automatically improves my growth probabilities significantly. I may mistime it, but all I need to track is if the company is going right in terms of execution. Anyways, coming back to your question, there is no intended bias, but we do like certain themes that are long term and that increase our probabilities of going right.
I think we're running out of time, Vasan. Thank you so much.
Thank you.
Wonderful. I totally love chatting with you. We hope all of you listening to us enjoyed this interaction. We'd love to hear from you. Look forward to speaking with you soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund family.